Today's company is Intel. For decades, Intel helped define the modern computer industry, but after years of manufacturing delays, market share losses, and heavy investment, the company is attempting one of the largest turnarounds in the semiconductor sector. Intel's second quarter 2026 results show a clear recovery in its core product businesses, but its foundry strategy is still expensive and largely unproven. So, is Intel's turnaround finally real? Let's look at how the company makes money, where growth is returning, and what could still derail its future. Intel was founded in 1968 by semiconductor pioneers Gordon Moore and Robert Noyce. The company later introduced the Intel 4004, widely recognized as the first commercially available microprocessor. During the 1990s, Intel became the dominant supplier of processors for personal computers. Its partnership with Microsoft created the so-called Wintel era, giving Intel enormous influence over the global PC market. But the following decade exposed serious weaknesses. Intel missed the mobile computing shift, suffered repeated manufacturing delays, and gradually lost ground to AMD and high-performance processors. At the same time, TSMC took the lead in advanced chip manufacturing. Today, Intel remains a major force in x86 computing. The company says it is also the only business conducting both leading-edge logic research and high-volume semiconductor manufacturing in the United States. Its current strategy, called IDM 2.0, is designed to rebuild that technological and manufacturing leadership. Intel's new structure separates the company into two connected businesses: Intel Products and Intel Foundry. Intel Products designs and sells processors for personal computers, data centers, artificial intelligence, and edge computing. This side develops the products and operates as an internal customer of the foundry. Intel Foundry manufactures those chips. It produces wafers for Intel's own product divisions, while also trying to attract external customers. This separation makes the economics of each business more visible. Product teams must account for the cost of manufacturing, while the foundry must compete for both internal and external demand. The objective is greater accountability, but it also reveals the size of Intel's manufacturing losses and how much external business is still needed to make the strategy work. Intel's Client Computing and Physical AI Group, or CCPG, generated approximately $8.9 billion in second quarter revenue. That was an increase of 13% from the previous year. The segment produced about $2.3 billion in operating profit, representing an operating margin of roughly 26%. This business includes Intel's processors for personal computers and a growing range of edge and physical AI applications. According to Intel, AI-capable PCs represented roughly 2/3 of its client product mix. Intel also began high-volume manufacturing of selected Panther Lake processors using its advanced 18A process. More than 130 customers are now adopting or testing Core Ultra Series 3 and Core Series 3 processors for edge AI and robotics. The key point is clear. Intel's largest traditional business is growing again, and its newest manufacturing process is now supporting real commercial products. Intel's strongest growth came from its data center and AI division, known as DCAI. Second quarter revenue reached approximately $6.3 billion, an increase of 59% year over year. The segment generated about $2.5 billion in operating profit, giving it an operating margin close to 40%. Intel said server demand was particularly strong, supported by cloud customers, enterprise AI workloads, higher server volumes, and a richer mix of premium products. The company also launched Xeon 6 Plus, codenamed Clearwater Forest. It is Intel's first server-class processor manufactured using the 18A process. But Intel's AI infrastructure strategy is not limited to CPUs. The company is combining Xeon processors with AI accelerators, networking products, and purpose-built silicon. The objective is to remain important inside AI infrastructure, even in a market where NVIDIA dominates the most valuable accelerator workloads. Intel Foundry is the most important and most difficult part of the company's turnaround. The segment reported approximately $5.8 billion in second quarter revenue, However, about $5.5 billion came from transactions with Intel's own product divisions and is eliminated when Intel calculates its consolidated revenue. External Foundry revenue was only $293 million. Most of its year-over-year increase came from Altera becoming an external customer after Intel sold a controlling stake in that business. At the same time, Intel Foundry reported an operating loss of approximately $2.09 billion. The loss improved compared with the previous year, but the central question remains unchanged. Can Intel attract major external customers at sufficient scale? Without significant third-party demand, the Foundry could remain a costly internal manufacturing operation, instead of becoming a true competitor to TSMC. Intel's manufacturing recovery begins with its 18A process. At the start of 2026, Intel released its first 18A products into high-volume production. A selected group of Panther Lake processors is now being manufactured at scale. Meanwhile, the enhanced 18AP process entered risk production in June 2026. Risk production means Intel has started manufacturing early chips to test the process, improve production yields, and prepare it for future high-volume manufacturing. The company's next major target is Intel 14A. During the second quarter, Intel committed to completing its development and said several future Intel products are being designed to use the new process. But 14A is not only a technology project. Developing a leading-edge process and building the required factories can cost tens of billions of dollars. Intel says the scale and timing of future manufacturing expansion will depend on committed demand from both its own product roadmap and significant external customers. In other words, technical progress alone is not enough. The new process must also generate an acceptable return on Intel's investment. At the consolidated level, Intel reported second quarter revenue of $16.1 billion. That was an increase of 25% year over year. GAAP operating income reached approximately $1.8 billion, with an operating margin of 11.1%. On a non-GAAP basis, Intel reported net income of approximately $2.2 billion. But the headline GAAP result looked dramatically worse. Intel reported a net loss attributable to the company of approximately $11 billion. At first, these figures appear contradictory. Revenue was growing, and the company remained profitable at the operating level. Yet, its final result showed an $11 billion net loss. The explanation comes from one very large, non-cash accounting adjustment. The main driver of Intel's GAAP loss was a $12.53 billion mark-to-market loss. It was connected to Intel shares held in escrow for the United States Department of Commerce. These shares are part of Intel's Secure Enclave Agreement under the CHIPS Act. As the fair value of Intel's escrowed share obligation increased, the company was required to record a larger derivative liability. This created the massive accounting loss shown on the income statement. Importantly, this was a non-cash charge during the quarter. It did not mean that $11 billion left Intel's bank account. However, the charge should not be completely ignored. The arrangement could still affect Intel through its liability value, potential shareholder dilution, and the economics of its government funding agreement. The correct interpretation is this: Intel's core operations generated approximately $1.8 billion in GAAP operating income, but a separate accounting adjustment pushed the final GAAP result deeply negative. Intel ended the second quarter with approximately $29.73 billion in cash and short-term investments. At the same time, the company carried approximately $50.54 billion in total debt. Cash generation improved. Intel produced $7 billion in cash from operations during the quarter. But advanced semiconductor manufacturing requires enormous and continuous investment. Intel must build fabrication facilities, purchase advanced equipment, and fund the development of future process technologies. The company is therefore becoming more selective with its expansion plans. Intel has slowed construction in Ohio and discontinued its previously planned projects in Germany and Poland to align spending more closely with expected market demand. Intel still has meaningful liquidity, but its large debt position reduces financial flexibility, while the Foundry continues to generate multi-billion-dollar operating losses. For the strategy to remain sustainable, Foundry revenue and investment returns must eventually improve. Intel is fighting two competitive battles at the same time. The first is the product design war. In personal computers and data centers, Intel competes with AMD, NVIDIA, and a growing ecosystem of ARM-based processors. AMD has gained market share in x86 computing, while NVIDIA holds the leading position in AI accelerators. The second battle is the manufacturing war. Intel Foundry is trying to compete with TSMC in process technology, manufacturing yields, advanced packaging, production capacity, and customer trust. AMD and NVIDIA can focus primarily on chip design because they outsource leading-edge production to manufacturers such as TSMC. Intel must design competitive processors while simultaneously funding and operating advanced factories. This integrated model could eventually become a strategic advantage, but only if Intel can execute successfully on both fronts. Intel has three major opportunities that could support its turnaround. The first is agentic and physical AI. AI processing is expanding beyond centralized cloud data centers into personal computers, industrial robots, and secure edge devices. Intel already has established customers and platforms in these markets. The second opportunity is advanced packaging. Technologies such as EMIBT allow different computing components to be combined into powerful and complex AI systems. Intel says demand is strong, with significant internal packaging requirements extending into 2027. The third opportunity is United States security and semiconductor sovereignty. The government wants a secure domestic supply of advanced chips, reducing dependence on overseas manufacturing. Intel has been awarded up to $3 billion for the Secure Enclave program, supporting trusted semiconductor production in the United States. These opportunities do not guarantee success, but they give Intel strategic advantages that many fabless competitors cannot reproduce with the same domestic manufacturing footprint. Intel's turnaround still faces three major risks. The first is external foundry adoption. Intel has committed to completing its 14A process, but future manufacturing expansion depends on significant customer commitments. Without enough external demand, new factories and process nodes may fail to generate acceptable financial returns. The second risk is execution. Any further delay in 18A, 18AP, or 14A could damage customer confidence and postpone the financial benefits of Intel's investments. The third risk is geopolitical exposure. Intel has significant manufacturing and product development operations in Israel. A major disruption to these facilities could materially affect production, product development, and financial results. Intel's future therefore depends on more than semiconductor demand. It requires consistent technical execution, external customer trust, disciplined capital spending, and operational stability across a complex global footprint. So, is Intel's turnaround finally real? The recovery in Intel's core product businesses appears real. Second quarter revenue increased 25%, reaching $16.1 billion. Client and physical AI revenue increased 13%, while data center and AI revenue grew 59%. Together, Intel products generated approximately $4.82 billion in operating income. Intel has also moved its first 18A products into high-volume production, showing that its manufacturing roadmap is producing commercial results. But the full turnaround remains incomplete. Intel Foundry reported an operating loss of approximately $2.09 billion. External foundry revenue remained limited at $293 million, and Intel's total debt remains significantly higher than its cash and short-term investments. The conclusion is balanced. Intel's product recovery is visible, but the success of its foundry strategy is still unproven. Its long-term future will depend on reducing manufacturing losses, maintaining process execution, and securing major external customers for future nodes. Every company has a story. We tell the numbers.